In the early phase of his journey in the stock market, a successful trader dedicates 70% of his time to building strong psychology and the remaining 30% to risk management. However, as his experience grows, 70% of his focus shifts toward risk management and only 30% on psychology. This is because, in the beginning, a trader spends most of his efforts on figuring out how to enter a position, where to book profits, and how to understand price action along with other concepts. Once these aspects are mastered, with increasing experience, the primary focus moves toward managing risk to protect capital and generate higher returns with minimal exposure. The reason is that trading psychology is completely dependent on risk management. Let's try to grasp this with an example, before moving into the strategy. If you find something valuable, do give it a thumbs up, and if you are new here, subscribe to our channel and turn on the notification bell so you never miss our latest uploads. We'll see you right after the intro and disclaimer. This is a 5-minute time frame chart of Bank Nifty, where the price, after forming strong bearish candles, faces rejection at the lower levels and starts moving upward. A green bullish candle with lower wick candles is formed on the chart. Now the price repeatedly tests the round number of 50,500, and psychologically it is unable to break below this level, which indicates a support zone is being created here. At this point, we have two retail traders with equal trading capital of about 50,000 each. Since the market may bounce by taking support from this level, the first trader assumes that the market could reverse upward from here. He enters a long position and places his stop loss below this green candle. On the other hand, the second trader decides to enter the same trade but without a stop loss, thinking that if the price goes below the support, he will manually exit the position. The very next candle forms as a strong bearish momentum candle, driving the market downward. Here, the stop loss of the first trader is triggered, causing him a loss of 1,000. He accepts this predefined loss without hesitation. Meanwhile, the second trader, who entered without a stop loss, remains stuck in the trade, hoping the market will still move upward. After some time, the price slightly retraces upward, giving him minor profit, but soon reverses again with a strong bearish momentum candle, pushing the market down rapidly, due to the fast decline and the effect of theta decay. His option premium loses value quickly. Watching his losses rise sharply, he panics and exits the trade. Now, the second trader ends up with a loss more than double that of the first. Because of proper risk management, the first trader's loss remains controlled, and since it was anticipated, it does not harm his trading psychology. In contrast, the second trader's failure to use risk management not only causes a larger capital loss but also leaves a negative psychological impact. The first trader bears only a 1,000 loss, i.e., around 2% of his total capital on a single trade, while the second trader suffers a 3,000 loss, nearly 6% of his capital. Although this may appear small, if both traders face 3 such losses in a single day, the first would lose just 6% of capital, but the second could lose 18%, i.e., about 9,000 or more. This size of loss is very difficult to recover, and the psychological damage to the second trader is far greater than the financial loss itself. So, the question is, how can we manage our risk effectively to strengthen our psychology? Let's find out. Reducing your losses or restricting them to a certain level while ensuring your profits are larger than the possible loss is what we call risk management. It is not rocket science, so there's no reason to make this concept overly complicated. Your main focus should simply be on keeping losses as small as possible. To achieve this, you need to apply a few straightforward techniques in trading. Let's go through them one by one. Point number 1. Always maintain a proper risk-to-reward ratio. In this chart, the price takes support from below, makes a high, and then forms a dragonfly doji or a long lower wick candle near the same support zone. Since this candle appears close to the support, according to price action, it is seen as a bullish setup. Now, if you follow a 1-to-1 risk-to-reward ratio by entering a long position with your stop loss placed below this candle, then your trading accuracy should be at least 60 to 70% to stay profitable. This means if you secure profits in 6 or 7 trades out of the last 10, then your accuracy is around 60 to 70%. Here, the profit target equals the stop loss distance. That makes this a 1-to-1 risk to reward setup, which in trading terms is considered the weakest ratio. Such setups are generally used by traders who have been consistently profitable for a long time and possess strong trading knowledge and experience. Because this approach requires extremely quick entry and exit decisions. Therefore, if you are a beginner, it's better to avoid trading with this ratio. On the same chart, if you set a 1-to-2 risk to reward ratio for your trade, it becomes a far more profitable setup. With this ratio, even if your accuracy is only 40%, meaning you hit profit on just 4 out of 10 trades, you will still end the series in profit because the reward is double the risk. If you are new to trading and working with smaller capital, this ratio can help you generate decent profits while protecting yourself from overtrading. That's why, before entering any position, you must decide how many points or what percentage of your capital you are ready to risk on that trade. If your stop loss is larger than your profit target, you should avoid taking such setups. Now, moving to the next topic. Now, in the next topic, we will understand how to pyramid quantity or average up, along with managing position size. This is the 5-minute time frame chart. After a gap up opening, the market starts falling and reaches near the 24,200 level, which also aligns with the previous day's swing high, and forms a rejection candle with a long lower wick. Since the market is close to this support area and a rejection candle has appeared, it signals the possibility of a reversal. As soon as a green bullish candle closes above the previous rejection candle, you can treat it as a confirmation and enter a long trade by keeping your stop loss below this support and setting the profit target near the day's high. Now let's assume your trading capital is $100,000, and for this trade, you decide to risk a maximum of $5,000, placing your stop loss accordingly. Because the market is falling sharply from higher levels, the probability of reversal here is almost 50-50, which makes this a low probability setup. That's why, instead of entering with the full 10 lots, as you would in a high probability setup, you should start with half the quantity, 5 lots, i.e., 50 quantity. After moving upward briefly, the price slowly turns downward. If you had entered with the full 10 lots initially, your losses would have increased quickly, forcing you to exit early. By the time a bearish candle forms, your loss would be around 3,000, already close to your 5,000 risk. At this stage, your psychology would push you to cut the trade early to protect the remaining 2,000, and you'd likely exit before the stop loss was hit. To avoid such situations, you can apply the technique of pyramiding or averaging up. Since this is a low probability setup, you first enter with only 5 lots, keeping the same stop loss and profit target. As the price dips against you, your loss is limited to about 1,500 instead of 3,000. With this controlled loss, your psychology remains stable, allowing you to hold the position calmly without rushing to exit. After some time, the market forms a strong bullish momentum candle. But here, you should not add your remaining quantity immediately, as such candles often trap retail traders. Instead, wait for the price to sustain above this candle. Once a bullish engulfing pattern appears, which is a strong bullish signal, you can add the remaining 5 lots above this candle. At this stage, the trade is already showing good profit, so shift your stop loss upward, slightly above your initial entry, to lock in gains. This way, even if the market reverses downward, you won't face a big loss since your stop loss is adjusted. When the market reaches the profit target, you can either exit the full quantity or book 70% and let the remaining 30% run for extended targets. By practicing this technique regularly, it becomes easier to hold winning trades, reduce unnecessary losses, and strengthen your trading psychology. Many traders argue that this leads to higher brokerage costs, which is true, but compared to preventing a major loss, the extra brokerage is negligible. After this, I will share an important point or practice. Let's assume your trading capital is 50,000, and you trade all 5 days of the week. On the first trading day, you earn a profit of around 5,000 after deducting brokerage and other charges. From this, you should withdraw at least 50% of the profit directly from your trading account. If you make a profit again the next day but have not withdrawn 50% of that day's profit, then you should neither withdraw any amount on that day nor add funds back into the account. If you follow this practice for about a month, you will notice significant improvement in your money management. The reason is, on the day after a losing session, when you start trading again, your available capital will be less than the previous day. This prevents you from doing revenge trading with larger capital or bigger positions to recover losses. It also helps you avoid overtrading, which directly strengthens your trading psychology and mindset. Small disciplines like these shape you into a consistently profitable trader. That's it for this video. Thank you for watching. I hope you found this valuable. If you did, be sure to hit the like button to show your support. And if you're new to the channel, don't forget to subscribe. See you in the next episode.